Silver is one of those assets that lives in a permanent identity crisis. It is not quite gold. It is not quite an industrial commodity. It is not quite a currency. It is all three of those things simultaneously, and that dual, or really triple nature, is both the most interesting thing about it as an investment and the source of most of the confusion around it. Gold gets the headlines. Gold gets the central bank purchases. Gold gets the doomsday prepper devotion and the ancient civilization mystique. Silver sits in gold's shadow and gets treated as the budget version of the same trade. Buy silver if you believe in gold but cannot afford gold. That is how most people think about it, and that framing misses almost everything that is actually interesting and important about silver as an asset. Because silver is fundamentally different from gold in ways that create a completely distinct risk and return profile. And understanding those differences is what this episode is about. We are going to go through the history, the supply and demand dynamics, the gold to silver ratio, and what it actually tells you. The industrial demand story, which is growing faster than most people realize, the ways to own it, and the honest framework for whether it belongs in your portfolio. Welcome to Better Investments. Let us start with what silver actually is, because unlike gold, silver has a split personality that shapes everything about how it behaves as an investment. Roughly half of all silver demand globally comes from industrial applications, not from investors, not from jewelry buyers, not from central banks. From industry. Silver is the most electrically conductive metal on Earth. More conductive than copper, more conductive than gold. It is also the most thermally conductive and has the highest optical reflectivity of any metal. These are not abstract properties. They translate into real-world applications that are embedded in the modern economy in ways that are growing, not shrinking. Solar panels use silver paste in their photovoltaic cells. Every solar panel manufactured contains roughly 20 milligrams of silver, and as the global solar build-out accelerates, the demand from that sector alone is becoming a significant and growing portion of total silver consumption. The Silver Institute, which tracks supply and demand data, estimated that solar panel manufacturing consumed over 160 million ounces of silver in 2023, and that number is projected to grow substantially as solar capacity continues to expand globally. Electric vehicles use silver in their electrical systems, charging infrastructure, and battery management systems. The average EV uses roughly twice as much silver as a conventional internal combustion vehicle. As EV adoption grows, silver demand from that sector grows with it. Silver is used in semiconductors, electronics, medical devices, water purification, antimicrobial coatings, and 5G infrastructure. The industrial demand story for silver is not a speculative future thesis. It is a present reality that is accelerating, driven by the energy transition and the digitization of the global economy. This is fundamentally different from gold, where industrial demand is a relatively small portion of total consumption, and the investment and central bank demand dominate the price. Silver sits at the intersection of precious metal and industrial metal, and that intersection is where the most interesting investment dynamics live. Now, let us talk about supply, because the supply side of silver has some important characteristics that most people overlook. Unlike gold, which is mined almost exclusively as a primary product, the majority of silver mined globally comes as a byproduct of mining other metals. Copper, lead, zinc, and gold mining all produce silver as a secondary output. This means that silver supply is not primarily driven by the silver price. If silver prices go up dramatically, it does not automatically incentivize miners to produce dramatically more silver. the way higher copper prices incentivize copper miners to expand copper production. The silver supply response to price signals is muted and indirect, because the primary decision of whether to expand a copper or zinc mine is based on copper and zinc economics, not silver economics. Total global silver supply runs roughly around 1 billion ounces per year, split between mine production, which accounts for about 80%, and recycling, which accounts for the rest. And here is the supply-demand dynamic that silver bulls point to most aggressively. In recent years, the silver market has been running structural deficits, demand exceeding supply. The Silver Institute reported significant deficits in both 2022 and 2023, driven by surging industrial demand, particularly from solar. When demand consistently exceeds supply in any commodity market, prices are supposed to respond. The reason silver prices have not responded as dramatically as the deficit numbers might suggest is that there are substantial above-ground stockpiles of silver held by investors and institutions that can flow into the market to fill supply gaps. But the bull case argues that as deficits persist, those stockpiles will gradually be drawn down, creating the conditions for a more significant price move. Now let us talk about the gold to silver ratio, because it is one of the most cited metrics in the precious metals space, and it is worth understanding what it actually means and what its limitations are. The gold to silver ratio is simply the price of 1 ounce of gold divided by the price of 1 ounce of silver. If gold is at $2,000 and silver is at $25, the ratio is 80, meaning it takes 80 ounces of silver to buy 1 ounce of gold. Historically, over very long time horizons, the ratio has averaged somewhere around 50 to 60. For much of monetary history, when both metals were used as currency, the ratio was fixed by governments at around 15 to 16, reflecting the natural geological occurrence ratio of silver to gold in the Earth's crust. In modern times, the ratio has been significantly higher than its historical averages, often trading between 60 and 90, and periodically spiking even higher. During the COVID panic in March 2020, the ratio briefly touched 125, meaning silver was historically cheap relative to gold. It subsequently compressed back towards 65 to 70 as silver rallied sharply in the recovery. Silver investors use the ratio as a relative value signal. When the ratio is historically high, silver looks cheap relative to gold, and the thesis is that it will mean revert toward historical averages, producing outperformance for silver relative to gold. When the ratio is historically low, silver looks expensive relative to gold. The limitation of this framework is that mean reversion can take a very long time, and the mean itself may be shifting as the industrial demand component of silver becomes more dominant relative to its monetary role. But as a rough relative value guide, the ratio is useful context, even if it should not be the sole basis for any investment decision. Here is the performance reality of silver, and it is important to understand honestly. Silver is significantly more volatile than gold. That sounds obvious, but the magnitude is worth appreciating. When precious metals bull markets happen, silver tends to outperform gold significantly on the upside. In the 2010 to 2011 precious metals rally, silver went from around $15 an ounce to nearly $50 an ounce. That is a more than 200% gain in roughly 18 months, while gold roughly doubled over the same period. Silver's leverage to a precious metals bull market is real and dramatic. But the downside volatility is equally severe. Silver crashed from nearly $50 back below $15 over the following years. From peak to trough, that is a 70% decline. The industrial component of silver demand means that when the global economy slows, silver gets hit from both directions. Investment demand falls as fear recedes, and industrial demand falls as manufacturing slows. This is why silver underperforms gold in risk-off economic environments and outperforms in risk-on environments with precious metals tailwinds. Silver is essentially a leveraged version of the gold trade, with an additional industrial beta layered on top. If you are bullish on gold and also bullish on industrial demand growth, particularly from the energy transition, silver is a way to express both of those views simultaneously, with more upside potential and more downside risk. If you just want a store of value and a hedge against financial instability, gold is the cleaner vehicle. Now, let us talk about the ways you can actually own silver. Because like gold, there are several options with meaningfully different characteristics. Physical silver is the most accessible entry point for most retail investors. Silver is dramatically cheaper per ounce than gold, which means you can buy meaningful quantities without enormous capital. American Silver Eagle coins, 1-ounce coins produced by the US Mint, are the most popular and recognizable form of physical silver and carry a premium over spot price that reflects their collectability and liquidity. Silver bars in 1-ounce, 5-ounce, 10-ounce, and 100-ounce sizes offer lower premiums over spot than coins, making them more efficient for pure investment purposes. The downsides of physical silver relative to physical gold are worth understanding. Silver is bulky. A $1,000 investment in silver at $25 per ounce gives you 40 ounces, which is a meaningful amount of metal to store securely. The same $1,000 in gold at $2,000 per ounce gives you half an ounce, which fits in your palm. If you are buying silver in meaningful quantities, storage becomes a real logistical consideration. Silver also tarnishes, which does not affect its melt value but can be aesthetically displeasing and requires care for collectible coins. Silver ETFs are the cleaner option for most investors who want investment exposure without the storage logistics. SLV is the largest and most liquid silver ETF, holding physical silver in a vault with shares representing fractional ownership of that silver. SIVR is an alternative with a slightly different fee structure. Both trade on major exchanges just like stocks and can be bought and sold in seconds through any brokerage account. Silver mining stocks offer leveraged exposure to the silver price, similar to the dynamic we discussed with gold miners. First Majestic Silver, Pan American Silver, and Wheaton Precious Metals are among the larger names in the space. Wheaton, in particular, operates on a streaming model where they provide upfront capital to mines in exchange for the right to purchase silver production at below market prices, which gives them a unique margin structure. Mining stocks carry all the operational and management risks of running a mining business on top of the underlying metal price exposure. They can dramatically outperform the metal in a bull market and dramatically underperform in a bear market. Here is the framework for thinking about silver in your own financial life. 1. Decide first whether you have a precious metals thesis at all. Silver, without a broader view on monetary instability, inflation risk, or dollar credibility concerns is a hard asset to own with conviction. If you believe in gold as portfolio insurance, silver as a complement or higher beta alternative to that view makes sense. If you do not have a precious metals thesis at all, silver is a speculative industrial commodity with extreme volatility and probably does not belong in your core portfolio. 2. Understand the industrial demand story and decide whether you believe it. The solar and EV-driven demand growth for silver is real and documented. Whether it translates into significantly higher prices depends on how quickly above-ground stockpiles are drawn down and how the supply side responds over time. This is a legitimate fundamental thesis, but it is not a certainty, and the timeline is uncertain. 3. Size the position appropriately for the volatility. Silver can move 10 to 15% in a week in an active market. It can fall 30 to 40% in a bear phase. Whatever you allocate to silver needs to be sized with that volatility in mind. Most portfolio frameworks that include precious metals suggest keeping the total precious metals allocation between 5 and 10% of a portfolio, with silver as a complement to gold rather than a replacement for it. 4. Use ETFs unless you have specific reasons to want physical metal. The storage logistics of meaningful physical silver holdings are real, and the ETFs offer clean, efficient exposure at low cost without the premium over spot that physical coins carry. 5. If you want physical silver for the genuine off-grid emergency preparedness angle, smaller denomination coins are more practical than bars for actual barter or exchange scenarios. A 100-ounce silver bar is difficult to make change for. 1-ounce coins are far more practical as an actual medium of exchange if that is part of your reasoning for holding physical metal. Here is the bottom line on silver. It is a genuinely interesting and genuinely complicated asset that sits at the intersection of monetary metal and industrial commodity in a way that creates a unique investment profile. The industrial demand story, driven by the energy transition, is real and growing. The supply dynamics, with byproduct mining creating a muted supply response to price increases, are structurally supportive over the long run. The volatility is real and extreme and requires the right temperament and position sizing to manage. And the gold to silver ratio provides useful relative value context, even if it should not be a mechanical trading signal. Silver is not gold. It is more volatile, more industrially driven, and more sensitive to the economic cycle. That makes it a different and, in some ways, more complex bet. But for investors who understand what they are buying and have a clear thesis for why they own it, silver deserves more serious consideration than its reputation as the poor man's gold would suggest. Next time on Better Investments, we are going back to real estate, but this time we are talking about the version most people actually consider when they think about becoming a landlord: rental. Houses. Single-family homes that you buy and rent out to tenants. Is being a landlord actually a path to wealth? Or is it a second job that pays less than people think and comes with headaches nobody warned you about? We are going to break down the real numbers, the real responsibilities, and the real framework for whether rental property belongs in your financial life. Subscribe so you do not miss it. And if this video gave you a genuinely new way to think about silver, share it with someone who has only ever thought of it as the cheaper version of gold. I will see you next time.